All right. Well, today is Friday, July 1st. I love that. I love that, Lloyd. That I think is just the perfect introduction for us. And we're going to have some fun today. It's 1 p.m. Pacific, 4 p.m. Eastern. My partner here is Lloyd Lofton with Power Behind the Sales. My name is Dan Vignal with WebPres Video. I want to welcome you to our weekly discussion for financial security sales professionals, where we talk about the business of selling annuities, life insurance, healthcare coverage, and employee benefits. On this week's show, we will be discussing how inflation and recession and economic news impacts your business and your clients. Lloyd will begin with how you can use the topic to engage your prospects in discussion, and I will follow with an idea on how to convert some of those discussions into real sales opportunities. Now, Lloyd, everyone seems to be talking about inflation and the cause, the cure, and more importantly, how inflation affects planning, as well as what, if anything, we can do about it. How can an agent or an advisor use the topic of inflation to engage prospects?
Well, let me respond to that with giving everyone watching the show, either now or the replay of it, giving you an instruction. And let me talk to you based on your role. So take off your agent hat, take off your advisor hat, and put on your consumer hat. And when you hear, and I'm not talking politics, so I don't care what side of the aisle you're on, but when you hear that we have inflation, but other countries' inflation is higher than us, do you feel like, whew, thank God, praise the Lord, their inflation's higher than us, even though statistics say that's just not true? But do you feel like, well, giddy up then, we're doing pretty good? Or do you feel like, my God, I filled my car up, and instead of it costing $35, I spent $50 to fill the car up? Do you feel like I used to go to Panda Express and get a plate for $6.50, and now it costs me $8, and that frustrates you? Because that's the point of view that we need to be talking to people from, right? So inflation is an impactful emotion on people's lifestyles. Inflation isn't an abstract concept. And I think that we view kind of inflation, and you hear it on some of the news channels. Like I watched some news channel this afternoon, and this administration official was talking about, well, you know, we might have to pay these high gas prices because you can't let Putin win. Well, let me tell you something. I'm taking my granddaughter, who's 15, flew out here from St. Louis on Wednesday. I'm taking her clothes shopping on Saturday. I feel sorry for the people in Ukraine. I feel, like everything that's happened is really horrible, but I don't want to pay like 30% more for her damn clothes because of it. We're the greatest country in the world. I want our country managed to benefit us, the American citizens. And if that's your view, if you kind of have that view about that, I'm guessing that your prospects and your clients want you to help them manage their retirement issues to best suit them, not what best suits somebody else. So inflation is not transitory. Inflation's emotional. At least that's how I view it.
Yeah. Now, that's microeconomics, is what's happening at the gas pump, what's happening at the grocery store, what's happening to personal budgets. And that certainly affects our retirement planning and retirement savings. And I think we have to, at least at this point in the discussion, we need to be cognizant of two separate markets, I think. One is pre-retirement. And by that, I mean probably people under the age of 50, maybe 55, and then after age 55, and people who are in retirement, preparing for retirement. Because I'll use a term that we're all familiar with, which is a sequence of returns, and that a lot of what I've been reading about advice to advisors on how to advise their clients keeps telling them, stay with it. Dollar cost averaging and, buy lows and, keep on doing it. Okay, that benefits the guys who are collecting assets under management, I'm sure. But the reality is, if you're in your 20s, 30s, or 40s, maybe even in your early 50s, you can look at a recession or an inflationary period and say, okay, I understand that there are fluctuations and variations in the market and there are going to be crashes. I understand that. And I just don't hope that I will recover any money that I lose over the next few months or few years, and that when I retire, it's all there. But what about the guy who's 55 and retiring in 5 years, or the guy who's 65 or 70 and is retired now, and he's living on maybe not a fixed income, maybe he's living on bond income, maybe he's living on fund income, maybe real estate income. And if inflation is affecting commercial leases, residential leases, it's affecting dividends, it's affecting all of those things. What do you tell the guy who's 60 years old and either, within 5 years of retirement, or the guy who's 70 years old and he's already retired and he's watching his asset values diminish, and not just the asset values, but he's watching his income diminish in real time? What do you do as an advisor? What do you tell that guy?
Well, let me step off of that and give you a scenario. So let's say that let's say I just turned 68, and in the last 3 or 4 years, my house has gone up 30% in value, maybe more. And I want to sell my house, and I want to pick up that gain now. But if I go out and buy a house, the house I have to buy is also gone up in 30% value.
Right.
So if I sell my house and take that gain, I'm just gonna spend it. So I've got a great idea. I'm gonna rent. I'm gonna rent for a year or two. I'm gonna see what happens to the market. My advisor told me that I should consider that. Smart idea. But let's look at the areas that I'm gonna rent in. Because of people like me, if I'm that, profile client, it's not going to take a year or two for those rents in those areas to go up.
Yeah.
And the very areas I'm renting in, I am now contributing to the inflation in those areas. And because I'm renting in the areas that I probably will end up wanting to buy a house in, by the time I buy the house, I've contributed to the inflation and other things being more expensive in the very areas I want to go into.
Right.
So it's a conundrum.
Right.
And I think that the issue is, and I think this is a great illustration and a great topic. I think the issue is the people. I'm talking to the consumers now. The people that need to be making these financial plans aren't the 55-year-olds. It's the 35 and 45-year-olds. They need to start thinking about that now.
Yeah.
Like right now. When you're 55 years old to 65 years old, you should be adjusting the plan you have in place. You should be adjusting the financial plan you have in place for your future retirement.
Meaning that your advisor should have already set you up to accommodate crashes and market volatility and recessions and things like that.
You might have 401ks, you might have Roth IRAs, you might have annuities, you might have bonds, you might have money in stock market, mutual fund. You should have some kind of plan in place, but that plan should have some triggers in it that bring about an automatic review.
Right.
I mean, wouldn't that be great if advisors, when they put plans together, if they set those plans up with triggers, market triggers, and behavior triggers, that when those things happen or those numbers get hit, the client and the advisor automatically agree that they're going to schedule a meeting that month.
Yeah.
And talk about the next thing. Maybe you're a fee only, or maybe you're a fee and some combination. Because if you're getting with 55 to 65-year-olds, you really only have what they have to work with right now, right? I mean, their income is only going to go up a certain amount from 55 to 65. I think the rule of 72 tells us how long it takes for money to double, right?
Right.
So if I'm 55 years old, how long do I have for my money to double? And is the market compatible for my money to double? And is
Right.
doubling my money actually reasonable? Maybe what's reasonable is to take the experience of what's happened in the last 2 years and what's going on in the marketplace right now and project that up ahead 20 years from now. I mean, how do we know another pandemic's not going to hit 20 years from now? But
Right.
now you're 75 years old. You don't have the opportunity to replace any losses. You don't have a regular W-2 income coming in, and you've only got what you got, and the prices are going up. What do you do then?
Yeah.
That's the kind of plan that advisors need to be talking about. You and I were talking about this before the show. If you're an advisor and you're counseling your clients on how you can stop the bleeding and the money they're losing in the marketplace, I would suggest that you're not a financial advisor, you're an investment advisor.
Right.
And that's okay. There's nothing wrong with that. But let's don't fool our clients into thinking that we're retirement advisors and the advice we're giving them is going to be what they're going to rely on at age 75 or 85 years old to live on, or their surviving spouse is going to live on that. We're giving you investment advice that's going to change over the next 90 days. I mean, all you have to do is follow the headlines. Last week when we were talking, we talked about how the market's going down. Well, yesterday and today, the market went up.
Yeah.
And now the headlines is that we're going into the second half of the year and the market jumped up 20%. Well, I don't know that I'd make a lot of investment changes right now until let that ride out for 30 days. But that might not necessarily impact what's going to happen to me at 75 or 85 years old.
Right. Right. I think this is a sales opportunity. I know it's a sales opportunity for insurance and annuity salespeople. Because understand this, I reviewed a video that we produced a few years ago called Inflation and Monetary Devaluation. And in that video, and you can see it, it's on our website, you can look at it for free. It's under the retirement planning category. Anyway, it's very disturbing. And if you show it to a prospect, I guarantee you they're going to have a reaction, if nothing less than a knee-jerk reaction. But basically what it says is that for the 20-year period from 2000 to 2020, the CPI index aggregated over that period of time, the US dollar lost 52.38% of its value. 52.38%. It lost more than half of its value in 20 years. Now, as you said, Lloyd, that there's somewhat of an abstract concept around inflation, but let's make that real. If I retired as a fireman, and I had in 2000, and at oftentimes firemen retire early, but they're 50, let's say 60 years old, and I retired with a $6,000 monthly benefit, and even if it goes up with inflation somewhat, it did not double in price. It's not up to $12,000 now. But if it was the same $6,000 in 2020, it would be worth $3,000. You would only be able to buy half of what you bought when you retired. Now you're 80 years old. Now maybe you're 80 years old and you're in a wheelchair and you're not doing anything. You don't spend any money. It's not a problem. But if you're healthy and you're 80 years old and you want to travel, you don't have the money anymore. Not because of anything you did, but simply because the rate of inflation, and that is the rate at which the government prints money in excess of the gross domestic product, then your money is being devalued. Now, to your point, you take the last couple of years and you project that out. Now inflation is running 7.5%, 8%, not 2.5%, which is what it averaged over the last 20 years.
Well, yesterday it was 8.6%.
Yeah. So now, using those numbers, your income, if you wanted everything to remain the same, your income, your house value, your asset values have to double every 6 years just to stay the same. So if you're an investment advisor, not a retirement planner, you're an investment advisor, and you come back to your client and you say, just stay the course because you're earning 10% on average or 12% on average, you're not really earning 10 or 12%. That's the rate of inflation. That's the only reason your assets are going up is not because the GDP is going up, because it's actually going down. Your assets are going up in value because they're printing money, and that money has to go somewhere, and it goes into asset values. It goes into the stock market. It goes in the real estate market. But everybody's saying, oh, I've got $1 million in my home equity. Yeah, well, that you don't really have. You have $1 million in current money, but it's not the same $1 million that you would have had when you bought the house 20 years ago, because inflation has eaten all that up. And that's the hardest thing for people to understand. And it's imperative that we as financial advisors, and it's almost comical, but we have to share that we have to educate the populace. We have to educate our clients and let them know this is not a small issue. This is a very, very serious issue. We're basically treading water. If you're working and you think your income's going up, you're treading water. If it's not going up more than 12% a year, you're treading water. If your home doesn't go up at least 12% a year, you're just treading water. If your asset portfolio, your 401k, your IRA, your anything else you have, your stock portfolio is not going up at least 12% a year, you're just treading water. You're not making money. You think you're making money. The media is telling you you're making money. The government's telling you the economy's great. It's not. The GDP is actually a minus 1.5%. I'm pulling these numbers out of Forbes and inflationdata.com. So these are not my numbers that I'm making up. The gross domestic product has been reduced over the last couple of years, primarily because of the pandemic, but also because of this money printing and people not working. So my point is that this is a very, very serious topic. And of course, you and I have fun with serious topics, and we're here to share this information with other financial advisors. And, if anybody out there has some suggestions on how to resolve this problem, beyond the fact that, I remember Henry Ford saying, reading a book on his biography, saying that in 1913, he said that if people understood how the banking system works and the federal banking system and fractionalized banking, he goes, there'd be a revolution tomorrow. And it hasn't changed. It's only gotten worse. And the fact that in the history of the world, every fiat currency, which is what the US dollar is, has failed within 200 years. Every single one, not 80%, not 90%, 100%. So if people are not aware that all of their wealth and their income and their lifestyle is dependent on a failing currency, then they're going to be caught in a very dire situation. And if you're a true financial advisor, a retirement advisor, or a planner, you have got to be cognizant of that. And you've got to talk about what are some of the alternatives or what you can do. And I'd like to come back to that after I hear your opinion on it.
Well, I think about the financial lesson that we give our kids. So my daughters become teenagers. They're not now, they're in their 30s and 40s. But they become teenagers and they come home and they say, hey, Dad, I saved $50. I got this dress for $100. And I say, hey, Kim, that's really good. You saved $50. Let me have the $50.
That you saved.
Well, she didn't have $50. She spent $100.
Yeah.
To me, that's the equivalent. Maybe some people won't agree with this, but that's the equivalent of saying, and I wrote an article about this a few years ago in Insurance News magazine, about saying, just hang in there.
Yeah.
Just hang. You're averaging 10% of the year. The market's kind of going down. Just hang in there. So let's say you hang in there for 2 years. And let's say 6 months of that 2 years, you lose. Let's say you have $100,000. 6 months of that 2 years, you lose 10 grand. But you hang in there, and at 2 years, 6 months, you're up to 110 grand. So people say, well, see, the market bounced back and I made my money back. Okay, here's my question for you. I'm not really good at math. I acknowledge that. But that 6 month that you were down 10 months, that you were down 10 grand, that's 6 months. If you hadn't been down, how much would you have made on that 10 grand?
Right. That's what you lost.
Oh, 10%.
Yeah.
So you would have made $1,000.
Right.
Right. So if I'm not great at math, but if I do the math, then you actually lost $11,000. The 10 and the 1,000 you can never gain back.
Right.
So this nonsense about just hang in there is exactly that. That's
Yeah.
why, and I want to show you. I want to show you an article that I found that I think here's one of the things financial advisors talk about right now in this market. In fact, if I was doing an annuity training, I would literally train on this topic, and that is for some people converting your 401ks right now. Like in the last 6 months, I would have talked about some people about converting that 401k because some of those 401ks, right, the value went down. So here's what, if I can do this, I'm not really good at doing this. So let me share this screen here. Here's the headline, and this is in Barron's Financial Investments. All right, here's the headline. What does that headline say?
Rolling over a 401k can cost you big time. How to save. Yeah, and that's in Barron's.
That's in Barron's.
Yeah.
But that's the exact kind of advice that some financial advisor would be giving their clients. And it makes perfect sense. You've got money in the 401k. The first thing you want to do is you want to match exactly what your employer will put in because that's free money. You don't want to throw away free money, right? You want to put any catch-up money in your 401k? Absolutely, no question about that. And because your 401k is going down, you might consider, rolling some of that over, maybe in a Roth or something. But Barron's tells you don't do that.
Right.
So when you go out and let me share one more that I think is hilarious, and I shared this with you earlier. Let me see if I can do it right. I know I messed it up when we were doing it before. Here you go. So you're a financial advisor, and you're going to advise your clients on the right thing to do in this market. Like you've been doing this for 12 years and 8 months. You're making $300,000 a year, and you are smart. I mean, you actually got an award with your company last year for being one of the top advisors because you know what to advise people. You're that smart. You like the setup?
Yeah, I'm waiting for the shoe to drop.
And so here we go. Supposedly the smartest guy about the market, the Federal Reserve Chairman, what does Jerome Powell say? He admits we now understand better how little we understand about inflation and insists that 41-year high prices were unprecedented.
Unpredicted. Yeah, they could not predict this.
So you're a financial advisor, and somehow you know more than the Fed chairman.
Yeah.
I mean, maybe the advice we need to give people is let's slow down.
Yeah.
Let's move away from the headlines. Let's talk about, you're now 85 years old. Talk to me about the house you live in. Talk to me about the lifestyle that you have. What car do you have out there? Is it paid for? Do you make a payment on it? Is your house paid for? What happens when you get cancer and you need some treatment? Do you have a Med Advantage plan, a Med Sup plan? How are we paying for these medical bills? What happens when your grandson graduates high school? Do you want to buy him a car? Talk to him about that lifestyle issue and walk them backwards from 85 to today.
Yeah.
And as you do that, somewhere along the line, they're going to start telling you, and that's when you get your little notepad out and your pen out, and they're going to start telling you that some of the things that are really important to them. So to me, there's a difference between an investment advisor. That's what the Barron's thing is referring to, being an investment advisor.
Right.
And being a financial advisor. There's different things. So I'm asked this question all the time. So what would you tell advisors to advise their clients? Well, I would tell you quit advising them and start asking questions to understand. And then help them put a plan together to accomplish what it is they want to do at the time they're going to take advantage of the plan you put together. Because as a financial advisor, correct me if I'm wrong, as a financial advisor, nothing you advise them on today is going to have a direct negative impact on 85 unless you don't follow up with them each year.
Yeah, good point.
Unless I'm missing that.
What I'd like to, I think what's really important, I've given this a lot of thought from our perspective is financial security. I always call it financial security. It's not financial advice. I find that most financial planners are focused on investments and growing or protecting wealth. But for the majority of Americans, their wealth is their retirement, right? I mean, that's the whole idea. You accumulate all this money and then you relax and you spend it until the day you die. And if there's some left over, you pass it on to your family. But I think we have a real shrewd opportunity here with the headlines the way they are and the economic conditions the way they are to talk about inflation, talk about the effects of inflation, and then talk about the market decline. I mean, we've had a 20% contraction in the S&P 500, which is considered a recessionary move. It's a bull move. We're in a bear market, and it may bounce back at around there. But the point is, people now know, hey, if I had $1 million in May, at the end of June, I might have had 800,000. That's 200,000. That's a 20% loss of my assets. Now, everybody understands the sequence of returns, which you were just describing. You know, it's if you lose 50% or you lose 20%, and there's a 10% correction in the market, the 10% gain in the market, you only get 2% up. You only recaptured 2% of the 20% you lost. So it may take you, and I read an article the other day in Money Magazine that said it typically takes from a recession, from a true crash. Now we're in a bear market, not a crash, but in a true crash, a recession, it takes about 5 years on average to recapture your original position. So for 5 years, which was your point, Lloyd, you're not earning any money. You've lost money, and you're losing the money you would have made on the lost money. This goes back to the compound interest concept, which we all heard Albert Einstein calling the eighth wonder of the world. Advisors need to really talk about the impact of that. But here's where the opportunity is. If you go in and you talk to somebody either about a fixed indexed annuity or an IUL that uses a point-to-point hedging strategy, this is a derivative concept. This is a very sophisticated concept that our insurance products have. Our insurance products are very sophisticated. They can be very complicated, even for those of us who sell them. But if you go back and you explain how the point-to-point reset works, and let's say that I'm going to take an extreme example. Well, let's take the example we're using. 20% correction in the market. Right now, today, the last 6 weeks, there's been a 20% down in the market, bear market. So now your $1 million is worth 800,000. If it goes up next year, or if it goes up over the next 12 months by 10%, you're going to recapture 2%, not the 20%. You're going to recapture 2% of the money you lost, or 10% of the money you lost, which is 2%. Now you're down 18%, not 20%. But if you go in and you tell them, are you willing to lose any more? No, I didn't want to lose what I lost. Do you want to protect yourself? Do you want to capture those gains as they go up? Well, yeah, I do, but I don't want to take any risk at losing more. Okay. We have a product, whether it's the IUL or the indexed annuity, we have a product that will guarantee that if the market goes down, no matter how far it goes down, 10, 20, 50, 100%, you're not going to lose any money. But as it goes up, it's going to start crediting your interest based on the new reset point. It's going to, so if you dropped from 100,000 down to, or 1 million down to 800,000, and the index you're using is now set at that price or that rate that you're at 800,000, and the index goes up over the next year by 10%, you're going in if you're in a mutual fund or you're in an ETF or you're in any of these fund plans or you're just in the stock market, you're going to gain back 10% of what you lost, 2%. But if you're in an index annuity or an index UL, you're going to gain back 50, 60, 70, 80% of that 10%. You might get 5, 6, 7, 8% of that gain that year instead of 2% of the loss. Does that make sense?
That makes sense.
And so, what a phenomenal opportunity we have. We can't solve the inflation problem. We can't solve the problem of Powell not knowing, being incompetent. We can't solve an incompetent government.
You mean Powell being honest?
Yeah, well, he's being honestly incompetent. Yeah. We can't solve the macro problem. But on a micro level, we can protect ourselves and put ourselves in the best position. And no one else, all the investment advisors don't like to sell fixed instruments. They don't like it. They don't like to sell insurance, and they sure as hell don't like selling annuities. But if you're a responsible retirement planner or financial planner, it is incumbent upon you to go in right now and say, look, I know a way to stop the bleeding, and I know a way to capture the gains in the market as the market recaptures its gains. I know how to do that. I can show you how to do that. And unless you're greedy, unless you say, I'm going to take more and more risk in the hope that I can gain back that 20% in a short period of time, then you need an investment advisor who's going to manage your risk. And understand, though, with risk, you have the chance that you're going to lose more. You're down from $1 million to 800,000. You go in and you risk more to earn more. You may be down to 400,000 by the end of the year. But with my solution, you will never lose another penny, and you will be guaranteed that as the market corrects and it recaptures its gains, you're going to get a substantial portion of those gains.
Yeah, exactly. Let me piggyback on that with this headline. And this headline actually talks about what you mentioned a few minutes ago. And this is a headline, okay? What does the headline say?
Raging U.S. inflation is far worse than we're being told, of course. If the government calculated price increases the same way it did in the 1980s, we'd already be in Jimmy Carter territory, writes former Restaurant Empire CEO Andy Pudster and ex-Senator Jim Talent. So that's.
Let's take that headline.
Yeah.
In the example you just gave, because this is another part of the equation. And then sorry, my allergies are really acting up. And then I'm going to give the question that I always give when we have these conversations. So let's take that scenario. $1 million drops to $800,000. I get a gain back on that. Let's say I pick up. How much did I pick up?
I'm sorry, say that again.
I had $1 million. It dropped to $800,000. I keep it in there. We get a gain back in the marketplace. I get 2% back. So how much did I gain back again?
So you gain back 160. No, you gain back 2% of the 240,000.
So I gained $40,000 back there. Here's the funny part about it. This is what I think is the funny part about it. So we're talking about the loss and all that stuff there. Here's the funny part about it. Probably, I don't take the 40,000 out, right? Probably I leave it in the market.
Right.
Because I want it to keep getting a gain.
Right. Compound interest.
And at the end of the year, I get a 1099.
Oh, yeah.
For the 40,000 that I gained on the 200,000 I lost. Right.
Right.
But then I pay taxes on.
Yeah.
That's the irony of that. So when financial advisors say, I don't want to sell fixed products, I used to love to go in the door behind them because I just ask one question. And this question always, like 95% of the time, always generated business. And I don't care what they said about how good they are in the market, how much they love their advisor, how much gains they got. I don't care what they said. And you've heard me say this question a million times. Of the money you have left, how much do you not want to risk anymore?
Right.
So that you can be more confident about the money you do keep in the market. And when they mention that $40,000, that's going to be an annuity. And I know that a year from now, no matter how, what a great job their financial advisor does for them, they're going to get something from that company that they're not going to get from me and the company I represent. And that is a 1099.
Yeah.
They're going to get a statement of earnings on the annuity.
Right.
So,
right.
So even if that's an argument I've never seen a financial advisor get around. no matter how good you are, if you're able to help them get a gain on the money they lost, assuming, I mean, that's a hypothetical, right? That's an oxymoron too, because you can't make a gain on what you lost. But let's say you get to $40,000, you're still going to pay taxes on it. So you've actually lost even more money.
Yeah, I think we have to be careful there because our tax laws are so convoluted. You take the loss. Some of those losses may
Capital
be
gains.
written off and carried forward,
Right.
and some of the losses, if they're within certain packages, are not going to be. But your point is well taken. Moving anything into an insurance product precludes the annual tax filing.
Right.
And I think that what's really important here is for us to, and I know you always end the show like this, tell people, look in the mirror and see yourself the way Lloyd and I see our profession, which is, instead of bucking heads with the investment advisors who are out there and, maybe they're the glitzy, glamorous profession, they're smoking big cigars and drinking brandy and wearing, $6,000 suits and $2,000 shoes. It's more glamorous than maybe what we do. But make no mistake about it. Insurance products have been around for a long, long time, and they are statistically valid. And while there are some insurance companies that don't operate with as much integrity as most of them do, if you are with a good insurance company, you're representing good insurance companies, you should be very confident, not only in the integrity of the company that underwrites the products, but in the products themselves, the way they're designed. Not only do we have extraordinary tax benefits, but as I said, this very sophisticated concept of hedging within an indexed credited fund is extraordinary. And if you truly understand it, you can sit there with a banker, a CPA, and an investment advisor, and you can go toe to toe. You don't have to argue that, hey, I'm going to outperform you. All you have to do is say, if the client wants safety and guarantees, none of you can do that. Only I can do that. And you have to go in with that mentality. You have to go in thinking, I'm the only one who can provide the client with what most clients say they want. I think we covered this on a previous show, but I think John Hancock did this study. And I think they have they have feet in both camps, in the investment camps. Everybody, they're required, an IRA is required to give a risk tolerance survey to every client, right? And keep that on file. But the way they ask the questions, we all learned this in Statistics 101. The way you ask questions in a survey will determine in many cases how people are inclined to answer it. But basically they ask people, how risk tolerant are you? How risk tolerant? From 1 to 10. Are you a 1, meaning that you have no tolerance whatsoever, or you're a 10, which means that I have a lot of risk, or somewhere in between? So John Hancock, I think it was John Hancock, did this study and found, the people are mostly somewhere in, the more money they have, the more risk they're willing to take. The less money they have, the less risk they're willing to take. But then they changed the survey question. And they said, how much of your retirement savings are you willing to lose? 96% said 0. What they're saying is, when you ask the question differently, you get a completely different answer. They don't have a tolerance for losing money. Only the investment advisor says, well, you got to take risk if you're going to have a reward. Yes, that's understandable. But after 20, 30, 40 years of socking away money in a 401k or an IRA, or building equity up in a piece of real estate, or even inheriting money that you didn't earn, the idea is to protect the wealth, not to risk the wealth. In fact, a good financial advisor would not put 100% of someone's assets into the market. They might put 20% in the market and save it. And what are we doing as retirement, as annuity and life insurance guys? Begging begging for give me 10% of your portfolio, give me 20% of your portfolio, and I'll protect that. And then take the rest and risk it. But if you turn the question around and ask them how much of your portfolio you're willing to lose, and they'll say none. Well, then why are you risking it? And we have the answer to you.
Well, I made a note of three different things on that. One of them is frame of mind, right? So people talk from their frame of reference and people hear from their frame of reference. So if you ask the question in a certain way, people think of investments. People don't view the average consumer, and maybe we should do a sub-market of people making $300,000 a year and more and $300,000 a year and less. But people generally that invest money aren't looking at that investment as their retirement funds because it's an investment. They expect it to go up and down. I think people talk from their frame of reference and people hear from their frame of reference. And people tend to view retirement money as, oh, that's the money that's not going to change. Like I'm going to have that same money coming in all the time.
Is that 401k and IRA money?
It may be.
But those are investments.
I know, but I'm just saying from a consumer's point of view, do they see an investment as the money I'm investing to make a gain on and I might lose some in the same emotional context as they do my retirement money? Because like you said, when you reframe the question, they absolutely don't want to risk their retirement money, but isn't their investment money their retirement money? Yeah. When you change the reference to it, it tugs in a different emotional response to them.
Good point.
So the second thing, and I'm going to share this, I looked it up real quick while you were sharing that. So this is from 2012. This is an article I wrote back in 2012. And Warren Buffett shared his shareholder letter out. And so I wrote an article, invest in stocks, yes, but don't forget about annuities. Because in Warren Buffett's shareholder letter, he talked about the importance, are you ready for it? He talked about the importance of having annuities as part of your portfolio. So yeah. you go back and look that article up and you can see that's what he was thinking about. So let's go to the risk tolerance. I loved it when I was out there as an active producer. When my clients could tell me what their risk tolerance was. When they told me I've got an investment advisor, I've had him for years, I trust him, he's really great, I would tell them that's good. You need to have somebody you have confidence in, that you believe in, and you can trust what they tell them. And it sounds like you can trust this guy, right? Yeah. So he did the risk tolerance with you, right? Yeah. So what's your risk tolerance? And they would do whatever it is, 6 or 7 or 4, whatever it was. And I loved it when they did that. In fact, if they had the paper, because, they give them paper. If they could pull the paperwork out, I loved it. Because I would take my trusty pen and circle it. And I'd say, well, here's what, can I give you some input on this? Yeah. So here's what my advice would be. And I would circle it. Let's say it's a 6, right? So they're willing to risk 60% of their money. I would circle it. I would say, in my opinion, and I'm not trying to take business away from me. I'd love to do business with you. But in my opinion, you trust this guy. You've been with him for the last 12 years. You feel like he's done a good job for you with the ups in the markets and the downs in the market, right? And they go, yeah. I think you should do exactly what he tells you to do. Exactly, word for word. And they look at you like, they look at the wife and, what? Yeah, I think you should carve out 60% of your funds and you should follow every piece of advice he gives you because clearly he's shown you he can be trusted, right? Yeah. And it sounds like, and I pull on my ear, it sounds like that 40% is what you're not willing to risk. And that's what I'm here to talk to you about. Is that okay?
Yeah.
And the minute they go, yeah, well, if they have $1 million, they just indirectly committed $400,000 to this conversation.
Yeah.
And I'm not saying I went after the 400,000, but I talked to him about, let's talk about that 400,000. Your advisor is going to do great with you on that 60, the 600,000. You've had 12 years experience on that.
Yeah.
Let's talk about what happens when you're 85. How does that 400,000 look now? Would it matter to you if the 400,000 went to 800,000? And would it matter to you if the 400,000 dropped to 100,000? Tell me how you feel about the 400,000 at 85 years old. And one of them, husband or wife, one of them would invariably say, well, I'd be happy if it was still 400,000 at 85.
Yeah.
Okay, well, let's talk about how to do that.
Yeah.
You want to look at some ways of doing that? I mean, that's the kind of conversation I think a financial advisor should have. I don't think you should compete with anyone else. I think you should contrast yourself to someone else.
Absolutely. And the only contention I have with what you just said was when because I know we all run into this. If you've got a guy with $1 million in discretionary assets, or I shouldn't say discretionary, but he's got it in assets, and those assets comprise his or her retirement. And they say, well, I'm okay risking 60%. Although I don't think, I've never talked to anybody who would say that, but let's say that they did. And you say, well, there's 400,000. Well, your knee-jerk reaction as an annuity salesman is, okay, that's a big number. It's a big part of his assets. And the FINRA tells me I'm not supposed to be greedy. I'm not supposed to go after that. Right. Hey, no, go after all 400,000. That's not even enough. You should have 80% of that. You should have 800,000, and you should go in with confidence. And it's not that you're going to say, okay, write a check and we're going to roll over 400,000 into this Allianz annuity. No, this is what planning is all about. You want to put some in a longevity annuity that shows up when they're 85, or a QLAC, where they can, if they've got money in an IRA, hey, use that IRA money, shelter it against the tax, the RMDs, and use that for later stage. Also, again, reminding them we've got an inflation issue. For the wife who says, I'm just be happy if we had 400,000 in another 20 years. No, you're not, because it won't be worth 400,000. It'll only be worth 200 or 100,000. So I would go after all of it. I would talk about annuity buckets. I would talk about annuity laddering. I would use at least 4 to 6 different annuities to map out their plan. But every one of them would be guaranteed. This guy would never come back and say, you lost me money that I couldn't afford to lose. In fact, in every single case, whether it was an immediate annuity or a deferred annuity, or even if it was a well-designed IUL, you can come back and say, your money's always going to be there, and it's always going to be earning money, and you're not going to lose it. That's what I do. I don't care what your investment advisor does. I'm just going to point out, I'm going to take your words. I'm going to take your words, Mr. Prospect. You tell me how much money you're willing to lose, and let's take the rest of it. And so if you tell me I'm not willing to lose any of it, then let's take 100% of it. Take that investment broker's portfolio and tell them tomorrow, hey, I'm writing checks. I want that money out of there. I don't want to lose any more money. And this is why the government, and this, usually I don't have anything good to say about the government, but in a competent moment, they've realized that they've got to endorse and promote annuities in 401ks and IRAs, because they realize this is what people need and this is what they want. And the people who are running 401ks and EFTs and mutual funds, they won't sell them an annuity unless we force them to. And this is what I'm trying to get across to our audience is, look, you need to turn the tables on Wall Street. You are the ones with the guarantees, and people want guarantees. They just don't know because they're not being asked properly.
Well, I mean, I agree 100% with that. I would even take it to a step further. Let's just stick with this profile client. We've got
a step further than my rant?
Absolutely. Let's stay with this profile client. He doesn't want to risk this 400,000 anymore. I might do this to him. I might say, well, let's talk about the 3 phases of your life that you've been telling me about from 85 backwards. Maybe the first thing we need to do is we need to create an estate outside of everything else you've got that guarantees if you pass before your wife does, her lifestyle's never going to be hurt. Let's move 100,000 of that into a single premium whole life life insurance policy and give her $300,000 at your desk so that she never has to worry again about what the economy is going to do.
Absolutely.
Let's give you something that your real estate broker can't give you. And that is, if you sold your house on January 1st of 2035, exactly how much would you get for it? Well, he can't tell you because he doesn't know what the market will do. But here's what I can do for you. I can tell you that you will have 100% choice of what to do with some of this money in 5 years, because you're going to be in a 5-year deferred annuity. You're going to have 100% choice of what to do with the balance of this money in 8 years, because you have an 8-year deferred annuity. So now you have, not only did you create an instant estate that guarantees security for your spouse when you pass away and she loses her Social Security income, which over 10 years is going to be more than $100,000. You just gave her $300,000. But every 5 years and 8 years, you're going to be able to look at the market and make new decisions without having to make those decisions based on the losses you've had. And that's something your stockbroker cannot promise you. So that $400,000 used properly can address the 3 lifestyle issues that you're concerned about. 85, 70 or 72, depending on what they do with their RMDs, right? It went up to 72. It could go up to more. And when you turn 65, because the problem with turning 65 and retiring is your expenses go up while your income goes down. And so what we're going to do is we're going to put you in a position where you can actually take a year or two when you first retire and kind of figure that out, regardless of what the stock market does. I'm glad that you have a risk ratio of 4 or 5 or so. I'm glad you have that ratio. So that I would do exactly what you said, but I would take it a step further, because the biggest, I think, for as financial advisors, the biggest thing you can do for your clients is give them choices.
But they have to be well-educated choices,
Absolutely.
right? They have to be informed. And I think that I totally agree with you, Lloyd, that the art of being a financial advisor. Now, we say financial security sales professionals. So a sales professional gets paid on the sale of a product. But you get to the sale of a product not by selling, but by informing and guiding and advising. And the key component here, I think, has always been education, but more so now because both macroeconomics are in the news as well as microeconomics, and it's complicated. And the average consumer does, and that's what we're talking about here. You know, let's not make any mistake. If you're dealing with what everybody wants, the high net worth individual, that's the top 1 or 2% of income earners or wealthy people in the United States. All right, then you just eliminated 98% of the U.S. population. That's fine. That's your market. You want to work with celebrities.
Can I throw something in here real quick?
Yeah.
But if you want the 10 million, 50 million, $100 million client, you've got to be the 10 million, 50 million, $100 million advisor.
Yeah.
And if you're not that advisor, you're never going to get that client anyway.
Exactly.
Because what we're telling you to do, what we're talking to you about, is exactly what those $100 million advisors do.
Yeah. You know, it just reoccurred to me many years ago when I was in my 20s. And I'm sure you probably read the same book, and almost everybody listening to this show has read Dale Carnegie's book, How to Win Friends and Influence People. And I'm not sure if it was in that book or another book that he talked about some of the wealthiest people in the world were shoe manufacturers and dry cleaners. They're not catering to the ultra wealthy, but they were wealthy. You don't have to cater to the ultra wealthy. You don't have to sell luxury products. I mean, I think people like that because it's glamorous, and we live in a society that idolizes celebrity and glamour. Okay, fine. If that's who you are, that's who you want to be. But I'm telling you, there's 50%, maybe 60% of the American public that is not being served financially by anybody who knows what the hell they're doing. Right. And that market is huge. When you're complaining about who do I talk to, are you kidding me? Every one of your neighbors, everyone at church, everyone in your children's friends, they're all prospects if you can educate them on what the issues are. And right now, the issue is rampant inflation, if not recession or pending recession, and explaining to them what the implications are to their wealth, to their income. They don't see it. It's like being the old adage, you can't see the forest for the trees. You're so, yes, you go to the microeconomics says you go to the gas pump and I used to pay 35, now it's 50. And I used to buy a loaf of bread for $1.50 and now it's $4. I'm feeling that. I feel that pain. But then they look at, but my house went up 20% in the last 2 years. And my IRA went up 20% in the last 2 years. So I'm okay. No, you're not. Those are devalued dollars. They don't buy anymore. And by the time you pull them out, that $5 loaf of bread, assuming everything else is the same, is going to be $20. Right. And you have to point it out to them that just go back in time. Look at the last 20 years. That price of bread was $1.50 or maybe less for a loaf of bread, and now it's $4 or $5 in 20 years. The 20 years you've been alive, the 20 years you've been earning money, the 20 years in which you've gotten 4 raises. I don't know, but you think you're making more money. You're not. I mean, unless you're outpacing inflation, which some people are, but that's a huge market for us to be talking to.
Yeah, I mean, I'm dating myself here, but if you used to go to the Wonder Bread store,
yeah, right,
and see the bread come down and smell it and get a slice of the fresh bread, and you can't do that anymore. Yeah. That's exactly what's going to happen with your lifestyle 20 years from now. Because 20 years ago, you could go to the One Bread store. There's not a One Bread store, and whatever you do now, that's not going to be there later.
Yeah. So let's wrap this up. I think that this has been a fun discussion for me. And as you can tell, I'm very passionate and very much a believer. That's not to say that all the insurance companies are doing the best that they can do. They're part of Wall Street too. But the concept of the products that we sell is very powerful. And we have a tremendous opportunity if we have the confidence in the products that we sell. So, Lloyd, wrap it up.
I'll tell you, I ran an agency office in Knoxville, Tennessee. And my wife used to come in. She's a social worker by trade, but she quit work and ended up raising our kids. But she used to come in the office and she would straighten the office up. And on our weekly meetings, she would bring like cupcakes in and, she would make the copies for me and do that kind of stuff. And agents used to say to me, gee, I wish my wife was like you, like your wife. And I would say, well, I get it. I'm lucky. I have that kind of wife. But part of the reason she's that kind of wife to me is because I'm that kind of husband to her. Right? You can't wish that your spouse was like somebody else if you're not more like the person they're with.
Yeah, right.
Right. So if you want a $100 million client, you have to be that type of advisor. So when you look in the mirror, do you see a highly trained, licensed professional? Because whoever you see in the mirror is most likely exactly who your prospect sees in the mirror. So you matter, you bring value to the table, and your prospects that you're currently not serving need you. And where they don't need you is in the back of the church, putting $20 in the basket because the lady's husband died and nobody, including you as an insurance agent or advisor, nobody approached them about life insurance. And now she has to be embarrassed in front of the church, begging for money to bury her damn husband. So look in the mirror and see a highly trained licensed professional because that's what your clients need. All right, guys, talk to you next week.
Next week. Thanks, Lloyd. Have a great